The Bank of England holds rates, but only just. US tech stocks wobble again. Australia's trade surplus grows as gold exports are strong. Japan's wage growth lags inflation. And Malaysia optimistically holds rates. That's coming up in our 5 Things in 5 Minutes on Friday, November the 7th. And then in our deep dive interview, ANZ FX analyst Felix looks at some key currency movements following the de-escalation in US-China trade conflict, including for dollar-yen.
The focus has really shifted at the moment to the Fed outlook. In terms of the impact from the US-China announcements, it's been a lot more muted, I think, than it would have been several months ago.
But first, in 5 and 5 with ANZ, the Bank of England held its key policy rate at 4% overnight, but it was a close-run thing, with 5 votes for holding and 4 in favour of a cut. Here's ANZ economist Bansi Madhavani on why the voting pattern had a dovish tone.
The committee noted that headline inflation has peaked and expects it to fall to around 3% next year. And there's also an acknowledgement of sluggish economic growth and a weaker labour market. The decision to hold policy rate unchanged was a closed one, with 5 members voting for a hold and 4 voting for a 25 basis point cut. Now, our view is that the policy statement and projections paved the way for a December rate cut. In our baseline forecasts, we have 25 basis point cuts penciled in for December, and again another one in first quarter of next year.
As at 4 a.m. Sydney Melbourne time, the S&P 500 was down 1.3% and the Nasdaq was down 2%, with tech stocks falling. The yield on the US 10-year Treasury was down 7 basis points to 4.08%. West Texas oil futures fell 1.1% to $58.97 US a barrel. Gold was down too, 0.4% to $3,977 US dollars an ounce. The US dollar index was down 0.4%. The Aussie dollar down 0.6% to 64.66 US cents, and the Kiwi was down 0.6% to 56.27 US cents. Number 2. Australia's goods trade surplus rose nearly $3 billion in September to $4 billion. ANZ economist Sophia Angala says that was driven by the strongest monthly gain in export values since April 2022.
The increase in export values in September was largely driven by a 62% month-on-month rise in non-monetary gold exports, and that was likely supported by rising gold prices in the month. But note this component is particularly volatile historically. Looking to other major goods export categories, resources also rose 4.4% month-on-month, and that result was driven by increases in metals, which recorded its strongest monthly gains since October 2023, and that category rose 14% month-on-month.
Number 3. Sophia says Australia's economy has been broadly resilient amid a period of global disruption from US trade policy.
Looking to Australia's exports to the US, on an annual basis, they are still hovering at an all-time high. The trend upwards in Australia's exports to the US from the beginning of this year was supported by US importers front-loading ahead of tariffs, as well as elevated exports of non-monetary gold to the US. But note, these are export values, so they are also affected by prices there.
Number 4. Malaysia's central bank held its benchmark rate at 2.75% as expected, pointing to a positive outlook for growth. ANZ economist Arindam Chakraborty says rates should be on hold into the medium term.
Domestically, B&M remains optimistic, with private consumption supported by a strong labour market and income-related policies. Investment is expected to stay resilient, driven by both public and private projects. Meanwhile, both headline and core inflation have remained mild year-to-date, and this pattern is likely to continue in the coming year due to moderate commodity prices and the absence of any excessive demand.
Number 5. In Japan, labour cash earnings grew 1.9% in September from a year ago, up from growth of 1.3% in August. Despite the rise, ANZ FX analyst Felix says real cash earnings were still negative, down 1.4%.
I guess overall still not really suggesting a huge heap of upside risk to inflation from the wages front, just given that, again, real wages still quite negative. They've been negative for most of the last few years, if not months, really. I did see Governor Ueda stress that, they are, as policymakers, looking at the trend in wages heading into the spring wage negotiations in early next year. So that will be key as well going forward. But just from these numbers alone, if anything, it does sort of underscore our view that the board will be quite careful about policy normalisation going forward.
Felix there, who we stay with for our deep dive interview after a week where currencies look to settle after the de-escalation in US-China trade tensions. Here he is talking about the dollar-yen.
The typical correlations would be that when we see, trade tensions and headwinds like that emerge in the global economy, the yen has historically been more of a safe haven, and so it catches a bit of a bid on that front. And the US dollar, of course, we've seen this year has been adversely impacted by a lot of tariff and trade news, really. But the main drivers of the yen at the moment have been, one, of course, what's happened with the bodge, and two, the surprise election outcome there, and that's really kept dollar yen over that 150 level at the moment there. So, also worth just considering that, when we think about Japan and the trade dynamics at the moment, that Japan is a key trading partner for China, in that a lot of key manufacturing items are exported to China there. So we do see a lot of correlations between in Chinese demand for Japanese goods and things like machine tool orders in Japan and so forth. So the outlook for China is quite relevant for Japan as well, and of course that flows through into what bodge do with policy there too. And we do know that the bodge are quite careful when they talk about the trade environment as a source of risk for the economic outlook as well. So in a way, when we do see risk to China's economic outlook, that also does pertain a bit to Japan as well, at least in terms of the export and manufacturing side of things there as well. So that still is a factor of the margins there for the yen, in the sense that that will make the bodge more cautious as well, and that we've seen not exactly a benefit for the yen at the moment either.
What currency moves have we seen since that de-escalation?
Well, I think in a way, this is not the first time this year we've seen trade dynamics impact currencies. April being probably the most salient point in time this year where, tariff announcements really hit currencies, or, drove a lot of volatility in asset markets, but currencies as well. But, as time has passed, the market has sort of taken these announcements a bit more in their stride. So yes, we did see some movements around the US-China news, Aussie dollar, Kiwi dollar being the most sensitive to that, standardly given how sensitive they are to risk sentiment. But beyond that, though, the focus has really shifted at the moment to the Fed outlook data in the US as well as being the major driver in the last couple of weeks, really. So in terms of the impact from the US-China announcements, it's been a lot more muted, I think, than it would have been several months ago. I think it just suggests that a lot of these tariffs and trade risks have, in a sense, already been sort of accounted for by markets at the moment.
Felix Ryan there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, November the 7th. Catch you next week with China's latest export and price data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.